Dhiraj Sachdev, CIO of Roha Venture, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Dhiraj, for joining us. First up, how are you looking at markets at the current juncture? There's been a significant correction both in terms of price and also valuations have become slightly more attractive. At this point of time, are you incrementally allocating capital to Indian equities?
Yeah, hi, good morning. See, the Indian equity market obviously has been facing volatility and last 2 months of steep correction. And this is largely with the noise of US Trump tariffs or elevated bond yields and strong dollar, which has impacted the FII flows. Now, over the longer term, if such tariffs significantly hurt US economic growth and trade, the dollar could weaken due to US growth and potential capital outflows. So weak US economic activity is actually preventing the dollar from strengthening on the tariff news, and we have been seeing over the last few days. Now, currency being the mother of all trends, any slide in dollar index augurs well for emerging markets in general, as far as flow is concerned.
Dhiraj, option then with Dhiraj Sachdev, CIO at Roha. Dhiraj, please go ahead. You were telling us about how you're viewing the markets right now.
So as you mentioned, if tariffs obviously could pose a risk on the US growth, and US markets can actually also suffer. So it's possible that eventually US markets decline will change or kick such Trump policies into shape as investors understand the damage caused to America from tariffs itself. So coming back to India, obviously domestic consumption trends have been improving and supported by higher retail spending or QSR growth and quick commerce. And the capex cycle is also expected to revive, driven by infra and PLI schemes. Though obviously in the first 9 months of the financial year, it has been slower than expected. Now, there are other macro variables which are also turning positive, like RBI has been cutting interest rates and further aiding further rate cuts going forward as well. So that's again positive part. So the tax cuts or rural demand recovery should aid economic activity and even the corporate earnings over a period of time. Now, more importantly, I think a lot of retail investors have been trapped in small and mid caps. And obviously, there's an obvious question, what needs to be done? The valuations in small and mid caps had been stretched in certain pockets like defense or railways and capital goods. And the recent correction has made many stocks attractive again. But this is a vast universe and stock selection should be bottom up rather than painting all small and mid cap companies with the same brush. So the ongoing market correction is a form of normalized market behavior to cut excesses of fraud that gets created and stretched in an extended bull market. Now, historically, we have also analyzed that several market corrections have taken anywhere between 1 to 6 months to recover. But stocks with strong earnings and reasonable valuations tend to bounce back faster. So while frothy or purely narrative-driven stocks may struggle, companies with reasonable valuations and growth should see renewed investor interest in our view.
Dhiraj, the texture of the market over the last 5 months was sell on any rally. Any small rally that we got was eventually sold into. Now, again, we're in the midst of some sort of a recovery. There has been some selling exhaustion. Do you think we made a durable bottom, or the continuation of the sell on rally trend will extend itself for some more time now, given the uncertainty?
Well, that's quite possible. Generally, when you see a very kind of a panic bottom, any rallies will obviously take out weaker players and they will choose to exit after 10 or 15% of the stock rallies. But there are certain companies, if you're talking about 6,000 to 7,000 universe of companies in the small and mid cap space, there will always be some companies where the valuations may be 30 or 40 times and they have moved far ahead of time. And even after the correction, they may still be relatively expensive. Well, there are a lot of companies which may have suffered collateral damage, maybe because of the leverage taken out of the system, and their valuations may be far cheaper or relatively attractive compared to many others. So there is a lot of dispersion or disparity as far as the valuation in the small and mid cap space is concerned. So I think, again, this year is going to be stock pickers market, where the valuations and earnings growth will have disproportionate returns across the portfolios. And we believe large part of the damage has been done. A section of the pocket may be still expensive.
Dhiraj, quick answer, if you may. In terms of commodities, how are you looking at metal and cement stocks? Currently, metals have gained a bit of a bounce. Cement stocks continue to languish. Given the dollar index has cooled off quite significantly, and also raw material prices have eased from on a year-on-year basis for cement, how do you view both of these pockets?
So cement demand so far in FY25 has been muted across segments due to low government spending and raw material cost availability, cost volatility. I mean, cement prices is seeing some signs of improvement across regions, though it is difficult to say whether these higher prices are likely to sustain because the utilization in the industry is still low at about 68 to 70%. And the capacity utilization is increasing, will increase the supply in FY26 as well. So price hikes undertaken by the companies over the last few months have been absorbed by the market, and demand is anticipated to revive going forward. But despite the price cyclicality, we remain tactically positive on the cement sector, given strong real estate traction and spending on infra and housing. We favor only selective mid-sized cement companies versus large cap due to valuation concerns. Now, on the commodity side, yes, I mean, there are tactical possibility when the dollar weakens, you will see commodity price getting positively impacted. And especially non-ferrous metal companies like zinc and aluminum, we expect they will report better earnings growth compared to steel companies. However, we remain cautious on the metal space due to weak global demand scenario. And besides the risk of trade war between the US and China and slower than expected stimulus-led real estate recovery in China calls for caution in the sector. And also on ferrous, while India has minimal direct steel exports to the US, Chinese dumping remains as a key risk.
Thank you so much, Dhiraj, for joining us and giving us the views on the market. Well, let's now slip into a short break. Up next, we'll discuss market technicals with Mitesh Thakur and also his top trading bets.